Hey everyone, let's talk about portfolio management. So let's say that you want to create a new allocation to a stock, but the optimizer, which of course would be the best way to do this, the optimizer doesn't work. This could, for example, be in the case of a stock that's been making recent losses, which would give it a high volatility and a low return, which would mean that a mean variance optimization would probably not assign any weight to it. So how can you then get a sense of how this stock would affect your portfolio if you can't actually get the optimizer to recommend an allocation? Well, one way that you can do it is by simulating a position in this stock instead. So let's take this example of 5 FAANG stocks in a current portfolio, and let's actually simulate a holding in Tesla and see how that might affect it. So the way that we'd go about this is we would again take our portfolio and open it up in Port, or if we have it loaded here in PRTU and then select Analyze, that will open it up in Port for you as well. Now what you're going to do is, instead of launching the optimizer, which is of course what you would do to create a mean variance optimal position in the new stock, let's say Tesla, now let's say instead that we're going to simulate a trade in Tesla. So check this simulated trades box, and now what we're going to be able to do is simulate historical trades. So right now you can see that there are no currently simulated trades going on, but if you go to holdings, if you open up the GICS sectors, you can see that we still have only the 5 FAANG stocks, and currently we are as of yesterday's date. But let's turn back the clock by about a month, so let's go to January the 3rd. And now let's say that we were going to add a simulated position in Tesla to our portfolio a month ago. Now, comparing the performance of this portfolio with Tesla over the prior month to the actual portfolio that of course doesn't have Tesla in it, this is going to let us get a sense of how a position in Tesla would actually have affected the performance of our portfolio. So even if we can't get a mean variance optimal allocation, we can still therefore diagnose just what effects this new position might have on our portfolio. So now that we are back a month in time, let's go to Add Holdings. And here let's add Tesla. Let's say that we're going to fund from holdings because we're not going to be adding any new cash to the portfolio. And let's play around with weights. So ideally what you're probably going to want to do is do this a few times, changing the different weights in this new simulated position in Tesla, and see what effect that actually has on your performance. So let's start by assigning maybe a weight of 4%. Now we're going to say recalculate, and what this is going to do is it's going to actually create a simulated version of our portfolio that has Tesla in it. So now if we open up our holdings, we see that now we have a new position. We have 3.85% of our portfolio in Tesla, and that's about as close as we were able to get using whole shares to that 4% target. So now let's go back to our original date, which is to say February the 3rd. Now since we've added a new position to the portfolio, the simulator asks us whether we want to actually review any corporate actions relative to this new position, which is to say things like dividends, splits, and of course we're going to say yes because we want to make sure that we track everything that's simulated about this new Tesla holding. So if Tesla pays a dividend, we want to make sure that our portfolio captures that dividend too. So we're going to say yes. It's going to go through whatever has been happening with Tesla over the last month. And now we've got our new portfolio as of yesterday with a simulated trade in Tesla that happened a month ago. So what can we do with this? Well, what we can say is if we go to the Performance tab, we can actually see how our portfolio with Tesla has done. Now if we go to Statistical Summary, and we compare our simulated portfolio with Tesla to the original portfolio without it, and we do the last month, you can ignore the first three columns, the 3-month, 6-month, and year-to-date, because our simulation only goes back 1 month. You can see that our rebalance date is January 3rd. That was when we simulated adding the Tesla holding. You can see that over the last month, the portfolio that would have had a 3.85% position in Tesla actually outperforms the original portfolio by about 2% total return. It has a higher maximum return, a similar standard deviation, a little bit higher downside risk, a little bit less skewness, which is good, about a little bit lower VAR, a positive information ratio. So on the whole, this simulation tells us that adding a 4% stake in Tesla would have actually improved the performance of our portfolio. Now remember, I was saying that you probably want to try a few different simulated weights just to see the variation in portfolio outcomes relative to the benchmark. So you want to clear this current one. So if you go back to holdings, then go to here, save trade. You definitely don't want to save or save as, because that would actually change your portfolio. But if you go to clear simulated trades, this will get rid of the simulated position of 4%, well, 3.85% in Tesla as of January 3rd. So go to clear simulated trades. It'll ask you for a confirmation, which you want to say yes to. And now you're going to be back to your default portfolio, which only has those 5 FAANG stocks in it again. So in other words, the nice thing about the simulation is that you can play around with positions and then revert them without changing anything. So now you again see that there are no simulated trades going on. So now let's again go back in time by a month to January 3rd. Let's add a different sized position in Tesla. So let's say this time, instead of 4%, we're going to go to, well, let's say 10%. We're again going to fund this position from holdings, so we're going to reduce all of the other 5 portfolio positions in this group of 5 stocks. We're going to recalculate. And now we're going to be able to again evaluate our performance. Remember though that we're going to have to go forward in time. Now that we have added this historical position in Tesla, let's go back to yesterday's date, the 3rd of February. You're again going to have to reapply corporate action since we've got this new simulated position in Tesla. It's going to think about that for a bit, but eventually we're going to end up with a correct dividend adjusted, split adjusted, and so on portfolio that has had a historical simulated position in Tesla over the past month. You're going to again go to performance and then statistical summary. And so now, as of yesterday, the performance over the past month of our portfolio, given this now higher simulated allocation to Tesla, is now even better. You can see that our total return has gone up from about 7.8 to 12.2%. Our VAR is now better. Our skewness is more positive. Our information ratio relative to our benchmark portfolio, the performance of which of course has not changed, the benchmark being the portfolio without the simulated trade in Tesla, the information ratio is sky high. So remember, this isn't really meant to provide any sort of definitive answer the way that a mean variance optimization would, but in cases where mean variance optimization simply doesn't give you any sort of allocation that you'd be able to use, simulating trades historically and then going back to the current date and seeing how your performance would change with various position sizes in these simulated trades can give you another sort of quantitative measure of the potential attractiveness of a new allocation, even if mean variance optimization doesn't actually recommend the allocation. Thanks for watching.